Hello everyone, I am your Bala. Welcome back to a new video. In this video, we are going to look into a summary of 10th chapter of the book Stocks to Riches written by Parag Parikh. So, hope all of you are enjoying the lively book reading experience from these videos and enjoying the animations of the videos. So, if you have any comment, do let me know in the comment section. And the early chapters, namely investment strategy, and third chapter 3 ways of investing, and the fourth chapter introduction to behavioral finance, fifth chapter loss aversion and sunk cost fallacy, sixth chapter decision paralysis and endowment effect, seventh chapter mental accounting, eighth chapter mental heuristics, ninth chapter an idea whose time has come have been covered in the earlier videos. And in this video we are going to look into a summary of the 10th chapter, the stock market bubble. What do Parag Parikh says about stock market bubble? He says in 5 major points in stock market bubble. First is the system thinking. What's the systems thinking in stock market? Let's go into it. System thinking. So here Parag Parikh discusses two types. One is the human body and other is the stock market. And we know the human body consists of different parts and organs. Each act separately, yet all work together and each impacting the others. In case of stock market, it's the beliefs and the behavior of various participants from time to time that shape their progress. Yeah, there are various participants in the stock market. So from their behavior and the beliefs, stock market is shaped in their progress. And this is meant by system thinking. And the second topic of the 10th chapter is the psychology of stock market participants. As we saw, it's about the behavior of the participants. Who are all the participants? We need to know. So there are 10 different participants in stock market. So let's see the psychology of stock market participants. So the first participant is government. Yeah, government do participate in stock market. Stock market send positive signals to foreign investors. Yeah, a good stock market, a increasing market send positive signals to foreign investors, and it is very important for government to capture foreign investors. This is why sometimes our Prime Minister Narendra Modi goes to various countries and speak with the Prime Minister and government officials and businessmen also and ask them to invest in India. Second is the regulator. They are appointed by the government, so of course they are also in the favor of positive markets. Next is stock exchanges. Stock exchanges facilitate transaction of stocks between the bulls and the bears. Bulls are nothing but who buys and bears are nothing but who sells, and their income increases in positive markets, because in positive markets a number of people will buy and a number of people will sell the stocks, so the transaction increases, so it will be good for them in positive market. Next is the brokers. So for brokers, the business opportunities increases only in positive markets, because only the people will be active in positive market more compared to negative market. And banks, yeah, the business of the banks also increases with the increasing stock market, because people take loans and invest, or people take the money from bank and invest in stock market and those kind of things. Companies. So the biggest positive for the companies is that the net worth of the owners and the companies increases in bull market. Mutual funds, and this is one of the important case. In mutual funds, a rising market attracts more investors. Exactly. Whenever the market is in rise, of course the news spreads and more investors tend to start SIP, systematic investment plan, in mutual funds. Next is the media. Increased viewers, which translates into increased ad revenue. So once the market is going good, so they talk more about the market, so viewers get increased, and by which they can able to generate more ad revenue. Investors. The lure of quick money draws investors in the bull market. Most investors invest their money only in bull markets. An operator understands the psychology of the participants and he has the ability to exploit. So these 10 are the various stock market participants. So the next topic is making the bubble. Yeah. So making the bubble has 3 subtopics. One is the stock price, second is the deal, and third is the circular trading. Let's discuss each of them. So making the bubble. First, the stock price. The management is the biggest beneficiary of the price increase, and it is its interest to keep the prices high. Of course, if the prices are high, then the net worth will increase. So they try to keep the prices high. Second is the deal. The management gives operator some stock at a current low price and a predetermined amount to rig the stock. So once the stock reaches a certain limit, they will try to rig the stock. Third is the circular trading. This process is done in 3 steps, namely step 1, step 2, step 3. So in step 1, first they create a reinforcing loop. So what it means? First, the broker 1 will sell the share to the broker 2. So once the broker 2 will buy, and he will sell it to a broker 3. And similarly, a pattern goes on from 3 to 4, 4 to 5, and again 5 to 6. So by this way, they increase the volume and the price get increased. So first first broker will buy for 100 and he will sell for 110. Second broker will buy for 110 and he might sell for 120. So once he keep on selling, so the prices and the volume increases. And the second step is the bubble swells. Here, so first the stock price will increase and the insiders enter in the stock. Next, the stock rises further. Then the mutual funds enter. Then the saliency used to get placed. Since then the stock still rises, then the retail investors enter at last, and the bubble starts. Next, the bubble at its peak. The stock keep on rising again, and the media and the CNBC reports cover the stock. People enter in herd mentality since everyone is making profit of it, and again the people try to enter the stock. Then it became the stock market favorite because it is giving returns quite dramatically. Next, more people enter on greed. Next, banks and private financiers also enter. So this is the making the bubble. So the next topic is bubble burst. So the bubble is made. Next, what is a burst? So first, to burst the bubble, first the bubble will be pricked out like it's a kind of a needle which touches a balloon. So first the stock start to fall. Second, there is a crisis of confidence occur in the investors. Second, some investors try to hold on to a stock. They anchor the stock. Next, media gives some mixed reports about the stock, plus and minuses. Then the initial paralysis occur. We can't able to make a decision whether we should hold on or we should sell. Next, the insider leaks information about the company. This is how the bubble is pricked. Next, the bubble burst. First, the fall continues. So the fear sets in. So fear becomes in command. Next, the selling pressure continues. And because of herd mentality, then the scams surface. Then negative media news. Then media starts to talk about the negatives of the stock or the company. And because of loss aversion, financials pull their money back. And the bubble eventually breaks. So the last topic in this chapter is summation. So here Parag Parikh says, in the bull market we need to know what's the source of money and from where the money to fuel the boom is coming. If a stock is rising, without knowing anything, we can't just go and invest in the stock. We just need to know what's the source of money, why the stock is rising, who are the investors. So by knowing this, we should invest in bull markets. And similarly, in bear markets, we must know the source of information and the actor paying on, and we need to act on paying on the inside information to depress the price. So in bull markets, we can't able to sell whatever we hold. So what's really bad for happen and why the stock price falls. So we need to know if the fundamental is still good, then we can able to hold on, and if not, then we can able to sell. And the classic cases here right now is Adani stocks. Here the bubble is created and the bubble burst, and right now the bubble is and the stock is keep on falling it. Next, it's the references. Coming to references, these are the references which Parag Parikh referred for this chapter. Hope you learned what is mutual funds and how to invest in it from this video. If so, then it would be kind of you to show your love by hitting the like button and subscribe to the channel so that you can able to watch the next chapter of the book, Stocks to Riches, where we will be looking into a stock, why one must invest. Until then, it's a bye from Bala. Keep learning and keep earning.